Welcome, everyone, to this week's session of Current Federal Tax Developments. I'm Ed Zollers, and today we're covering the key developments for the week of February the 2nd, 2026. I'm coming here from Phoenix, and we have a mix of procedural updates, significant tax court opinions regarding evidence and substantial compliance, and new implementation details regarding the federal mandate for electronic payments, all of which, of course, are going to impact us here shortly. So let's get going with what we have this week. So our roadmap for today, we're going to start with an issue of changing the presumption of delivery. Going to start with the Hillenbrand case, where the tax court remanded a collection due process determination. The court found the credible taxpayer testimony could overcome the Postal Service tracking records to prove non-receipt of a notice of deficiency, allowing the taxpayer in the collection due process proceeding to challenge the amount that was being claimed by the IRS as due. Next, we're going to look at Aguirre, hopefully I got that right, which is a cautionary tale involving a tax return preparer. The court rejected his Conduit defense against a bank deposit analysis due to a lack of contemporaneous records. Next up, we're going to go into two different developments on a related topic. We're first going to discuss the new notice CP53E. This notice will be issued when a return lacks direct deposit information and will impose a one opportunity rule to fix it online before going back to a paper check. And that goes under Executive Order 14247 from last March. Continuing down that path, we're going to cover a brand new fact sheet the IRS put out, 2026-02. And this updated fact sheet details the phase out of paper checks and the freeze on new individual enrollments in EFTPS as of late 2025, along with some other information about this transition to a fully electronic payment system. Then we move on to a case of United States versus Neuberger, which is a case we've visited before. This is part two of it. But this is a district court case that limits the representative's personal liability under Section 3113B to the amount known at the time of the wrongful distribution, rejecting the government's claim for after accruing penalties and interest under the code. If you remember that case, we'll discuss that, but Neuberger was an attorney that was involved in assisting his client in setting up certain tax structures, and he ended up with personal liability for the amounts that were transferred from one corporation, which owed a ton of tax by the time we were done, to other parties to, quote, basically pay off loans was the theory. We're then also going to go to review the Aventus Inc. case where the tax court dismantled a legacy securitization structure. And it ruled substantial compliance cannot save a transaction that falls within the essential statutory definition of code section. So even though the actual structure we're going to talk about today is not one you can set up today, the concept of having to make sure you dot your I's and cross your T's when you have provisions that are specified in the code itself, that's still very, very relevant. So let's go on to the first case. And this is the Hillenbrand case. It is husband and wife, so it's both Kirsten Hillebrand and Shay Hillebrand versus Commissioner. It is a tax court order, and these are cases number 18927-23L and 18928-23L. And the orders came down on January 23rd of 2026. So this is a procedural victory for the taxpayers in this case regarding question of the presumption of delivery of the notice of deficiency in a collection due process case. And on January 23rd, the tax court issued orders in two related cases, the husband and wife, Kirsten and Shay Hillebrand. And the core issue here is one we encounter frequently in practice. The intersection of the IRS's proof of mailing a notice of deficiency versus the taxpayer saying, we never got it, right? You see that happen and, right, IRS says you got this. This is why these bills are here. You've missed your 90-day period. We got some things we got to work with here. And the taxpayer claimed they never got it. And of course, the service will come back with a proof of mailing document. And that's a problem because if the taxpayers can't show that they didn't receive the notice, or if the IRS can't prove that they sent it out properly, it's kind of the flip side of that, we end up with an issue because if the taxpayers receive the 90-day notice and just decided to ignore it, that's not a good factor in terms of you won't be able to challenge underlying liability, and your collection due process will be limited to just, basically coming up with a way to pay something to make it go. And typically, a properly mailed notice of deficiency will cut off the ability of the taxpayer to challenge the underlying liability in that collection due process hearings. However, these two cases explore the evidentiary weight of United States Postal Service tracking records when contradicted by taxpayer testimony. If they have a Postal Service tracking record of delivery, is there any way for the taxpayer to establish that it wasn't truly delivered? And in this case, we do find we're going to have a case where they're able to establish that. So let's take a look at the facts of this case. In this case, we have spouses. They lived in Arizona, and they were dealing with assessment for 2012 and 2018 tax years. After receiving a final notice of intent to levy letter, 1058-A, they requested a collection due process hearing. And the dispute in question here crystallized when the representative argued the taxpayer never received the statutory notice of deficiency. That opens the doors to challenge the tax the IRS claims they owed. Now, the administrative record was kind of problematic in this case. Copies of the 2018 notices were undated, and the second 2012 notice was missing entirely from the file. Now, despite these issues we had, so the IRS was already not in the best position, the settlement officer relied on the Internal Revenue Manual, and they were using a certified mailing list to verify issuance to the correct address. The settlement officer took a hard line, asserting that refusal to accept or pick up notice is not a defense, and sustained the levy. The IRS in this case now has moved for summary judgment of the tax court, bolstering administrative records with United States Postal Service tracking numbers and a signature purporting to confirm receipt. So the Postal Service say, here it is, we have this, we have the Postal Service information that confirms receipt of the document. Now we're going to take a look at, basically the critical procedural mechanics that allowed the taxpayers to survive this summary judgment. Under Internal Revenue Code Section 6330C2B, a taxpayer can only challenge the underlying liability in a collection due process case if they did not receive the notice of deficiency or have a prior opportunity to contest. Confessing probably is not great, but contesting would be useful. The standard of review is a key point here. When the underlying liability is at issue, the tax court reviews determination de novo. Now that means they go and look at the entire record, evidential record. For all other issues, they look for an abuse of discretion by the service. And when you do it de novo, the court can essentially make its own decision based on the evidence. When they're looking for abuse of discretion, they're not going to overturn the situation or, basically throw it out and say, hey guys, IRS, you got to go back to square one and, have another basically appeals hearing in this case, or CDP hearing, just because, we might have done it differently unless the settlement officer abused their discretion. Now, why this matters is, under Keller versus Commissioner, abuse discretion review is limited strictly to the administrative record. However, because the court had determined its liability challenge was precluded by receipt of the notice, they applied the de novo standard where they go look at everything, not just the administrative record. This allowed the court to look beyond that record and hold an evidentiary hearing to consider testimony from the husband and wife. That ultimately changed the outcome. Because again, based on the administrative record, we have a record from the Postal Service. This document was delivered. Therefore, even though we have some issues, there was proof of delivery. That's what they go, and that's what's in the administrative record. But there's more to this story. So this is where the presumption of regularity meets reality. A properly completed Form 3877 generally creates a presumption of mailing. Now, presumption means that generally that's going to be good enough, a prima facie case, but it is open to someone overcoming the presumption. Under Sagal versus Commissioner, a taxpayer can rebut the presumption of receipt by a preponderance of the evidence, provided they did not deliberately refuse delivery. Of course, remember the SO said, well, they deliberately, they refused delivery or just didn't pick it up. Now, the IRS had a tracking number and a signature. And generally, if that's what you're facing from the service, it's game over, right? We just don't have any out there. There is that's going to be considered very, very difficult evidence to overcome. However, in this case, the taxpayer's testimony was credible for reasons that your client might have trouble meeting. But the fact is, I doubt that you would have thought of this particular opening unless you looked at the actual facts of your taxpayer and why they're different. In this case, the husband was a former professional athlete, and he testified to very specific privacy practices. Namely, he never answers the door. Now, he testified that the signature on the Postal Service record was not his. His wife testified that she was not at home at the time of the alleged delivery. And so the court, weighing the specific credible testimony against the Postal Service records, the court found by preponderance of the evidence that the notices were not received. They believed the taxpayer. By the way, this is one of the reasons why I've always said the taxpayer's credibility can be incredibly important. If you're a taxpayer, and that's why little things the taxpayer has done that get caught on exam, that appears to be they're trying to sneak things by or sneak things through, those can have a much greater cost than merely giving up that deduction. It begins to, whittle away, and it looks like it's going to be pretty easy if you actually had to go in front of a judge to make it seem that you just really can't believe these people. Look at all the stuff they did that we caught them red-handed with, and now they want you to believe this story. So credibility is very important. The taxpayer's testimony by itself is generally not good enough, but if the taxpayer is credible, you'll find that that testimony can go a lot further than it would go in other cases. If the Hillenbrands were not credible, if they had blown their credibility somehow in the process, I suspect we'd have a very different result. The court would say, well, I'm not going to believe that that doesn't seem right, etc. So really helps to keep your credibility in this case. So a few key things to take away from this. First, do not assume automatically a United States Postal Service tracking number is absolute. If you have a client with credible facts and credibility, suggesting non-receipt and a signature that doesn't match, you have a shot at overcoming the presumption, and you point that out. When you're going in there and you're talking with a settlement officer, point out that, if we go ahead and if we challenge this in court, there is a chance, we have good records. Take a look at the Hildebrand situation, and you'll see that, you need to consider these other issues. Also, procedural preservation is valid. The court noted the taxpayer raised the receipt issue during the hearing. You've got to bring it up. You must explicitly request consideration of the underlying liability during the CDP hearing to preserve that argument when you go to court. You can't keep bringing things up later, and we're going to discover that a few times in other things we'll talk about this week. You need to bring things up early enough. You can't, you don't get a whole lot of different swings at this. You don't get a whole lot of different swings at the pitch, shall we say. You got to go ahead and, make your case right up front. And finally, the result here was a remand. Because they didn't receive the notices, they were denied a prior opportunity to contest the tax. So the court ordered a supplemental administrative hearing to allow them to dispute the liability on the merits. This does not mean the Hillebrands aren't going to end up having to pay the tax. They still got to go there, but they weren't even allowed to discuss whether they should have been, held liable for the tax. So that question is back on the table and could at least end up with a reduction in the tax they start with before we get to the collection issues in the case. So, hey, the infographics we started using now, and again, as it says in the corner, this comes from Notebook LM. which is useful. You give it a case and you give it the background, and it comes up with this illustration we have. And we'll be able to download the slides or PDFs of the slides this week, so you can get this little illustration too if you want to. So basically, what we're looking at here was a conflict, left side of the slide when you're looking at it on the screen. And that is the central conflict that was just discussed. We have the IRS position, which is usually impregnable. They produce a certified mailing list, a United States Postal Service tracking number, and a signature confirming delivery. Under normal circumstances and the presumption of regularity, this evidence would shut the door on the ability of the taxpayer to contest the underlying liability in collection due process hearings. We're not talking about whether you owe the amount anymore. We're just talking about, what options are there going to be to get it paid, or maybe get it, get some other collection alternative aside from the IRS taking stuff. Now, in the center of that infographic, there is a set of these specific facts. And the turning point here was the specific credible testimony detailed in the center bubbles you've got there, right? That they never received the notice. The professional athlete defense wasn't just a claim of, I didn't get it. You can't just your testimony, I didn't get it by itself is probably not going to overcome what they had. But it was a plausible explanation of privacy habits, specifically that the husband never answers the door and the signature on the postal record did not match his own. And the wife corroborated this by testifying she wasn't home. And presumably they had backup if questioned that would be able to show that she wasn't there and other ways to corroborate what the husband did. But it made sense, right? The signature didn't look right. The husband doesn't only answer the door, and the wife was, at a certain place. So presuming all of that, right, and the IRS wasn't contesting it, they were saying, well, that's not delivery, right? We don't have that. Now, this brings us to basically the pivot of the case, where legally we pivot this. The court ruling came down, it's on the right side of the slide, and the court found that specific testimony was sufficient to rebut the presumption of receipt by a preponderance of the evidence. This is not a criminal trial, where we're looking at, basically having a high level to clear, just a simple preponderance. So you have more evidence on your side than they have on their side. It's a reminder that the United States Postal Service records are a presumption, but presumptions with the right facts can be overcome. And now what they've got is not you're not going to pay, but they've got a second chance. The remedy available here is the court accepted they never received the notice. They were legally denied their prior opportunity to contest the tax. As a result, the tax isn't wiped out. Like I said, they haven't won yet. They haven't won anything except they've won the right to argue they shouldn't have owed the tax, or at least shouldn't have owed part of it. But the case is remanded to appeals for a supplemental hearing where they can finally argue the merits. That's what they've got. They've got their day in court on that question. Next up, we're going to talk about bank deposits, conduit theories, and the sloppy tax preparer. This is Aguirre versus Commissioner, Tax Department Decision 2026-8. And again, the decision came down January 26th. This is a situation that unfortunately is all too common in tax litigation. The collision of poor record keeping with the IRS going to the bank deposit methods of income reconstruction. Right. Now, what makes this case particularly notable and probably egregious in that case is the identity of the taxpayer. This was not an unsophisticated layperson. He was a prolific tax return preparer who filed thousands of returns annually. If you're in the tax preparation business, holding yourself out to be a tax expert, you should know about the need to keep records. Now, the core dispute here involves unreported income discovered via a bank deposits analysis. That's where the IRS takes a look at your bank accounts, takes a look at funds that come in, take a look at known sources, things that were put in return, and let's say documented loans and those sorts of things, and comes up with this much of the amount that came in cannot be explained. And if the records are really bad, right, because we can't explain those deposits, the court will accept in the bank deposit analysis that those extra deposits represent income. Now, the taxpayer's defense in this case was a conduit theory. They were arguing he was merely a pass-through vehicle for funds that his customers were giving to charity. As we will see, without the books and records that are required by Internal Revenue Code Section 6001, and which he as a preparer should know are required by that section, the defense crumbled once they got to court. Let's take a look first at the operational facts. The taxpayer, Mr. Algarari, wore multiple hats. He was a real estate broker. He was the president of a refugee center called All Nation, and he was a sole proprietor of a tax practice. And his practice was high volume, to say the least. He prepared 1,294 returns in 2020 and nearly 2,000 in 2021. Despite this volume, his internal controls were, in the view of the court, effectively non-existent. He utilized a literal donation box outside his office and solicited funds via Facebook using a Zelle account that's linked to his personal phone number. And he encouraged clients to donate to the refugee center in lieu of payment for his services. You can pay me, or you can just put it in the box there, for the donation and do that. Now, all of these funds, no matter what they were, whether they were used to pay his bill or whether they went into that box, they were all commingled, and essentially there was no separate bank account for All Nation. Everything went into his personal account. No matter no matter if you gave to the charity or you paid his bill, it all went into his personal bank account. And the reporting gap here was rather massive. While he reported only about 12,500 in gross receipts annually on Schedule C, the bank deposit analysis identified approximately 165,000 in underreported income across the 2 years at issue. So, yeah, there's, most of the money, he said, essentially, he's claiming in court now that discrepancy represents charitable monies that his customers gave. Now, just at first glance, ignoring anything else, it would seem most of us might think, who are in the business of doing this, that it's a little tough to live on only 12,000 of gross receipts for the year. Especially if you have a practice that apparently, in this case, we're saying, was probably generating, since they could pay in the box and give to the charity, or they could give it to him and pay his fee, that all of this represented funds used for preparing tax returns that he had prepared. So, he had basically a practice that was generating effectively 175,500 of revenue, but he was only reporting 12.5, and the rest he claimed his customers had elected to donate to charity in lieu of paying him. You might see why there's a little bit of a, is this plausible view to the case before the court ever got into it. Now, the rejection of the conduit theory, faced with the bank deposit analysis, he had argued he was merely a conduit. He was an intermediary collecting funds to assist families in need. And the legal hurdle, the court found, is the doctrine of dominion and control. Income includes deposits into accounts over which the taxpayer exercises such dominion and control. To succeed on a conduit theory, the taxpayer must provide specific evidence tying the deposits to payouts to the ultimate recipients, and that he was obligated to do so. And the court found the record completely lacking. The taxpayer had no contemporaneous records tracing these funds. The organization, All Nation, lacked tax-exempt status, and, as we already mentioned, it had no separate bank account. Without a paper showing $A came in for the charity and $A went out to the recipient, the court couldn't distinguish taxable income from these alleged pass-through gifts. Consequently, the court assumed that he had full dominion and control over all deposits, meaning it was all income to him. The case also serves a little bit as a refresher on tax court procedure and the standing pretrial order, as well as trying to sneak changes in at the last second. The taxpayer attempted to introduce letters from community members testifying to his charitable acts. The court excluded them because they were not exchanged at least 14 days before trial. The court notes that you have rules And these rules about not continuing to be able to bring up things later, they exist to prevent a trial by ambush, where one or the other parties coming into court that day has no clue that this evidence is going to show up. And while that was very good for the Perry Mason style cases, where there's always some big thing that just, came out at trial and you were effectively ambushed, but usually Perry got something out of one of the prosecution's witnesses that ends up killing their case. Well, in this case, they just were kind of bringing this stuff up for evidence of all these good things they had done without bringing them up early enough. Even if they had been admitted, though, the court noted they were inadmissible hearsay, and more importantly, they were irrelevant to the specific accounting issue. That is, the court held letters written years later cannot retrospectively trace specific deposit flows. Letters just saying you're a good guy and you do good work, that doesn't help the problem if we have to trace this money. That's not doing it. And finally, he's still going to try some stuff later. In a post-trial maneuver, the taxpayer tried to submit unsigned amended returns claiming COVID-19 sick and family leave credits. And the court rejected this under Rule 34B1G of the tax court, deeming issues not raised in the petition as conceded. You cannot raise new affirmative claims in a post-trial brief. There's a reason there's a trial date, right? That's supposed to be the date we're going to get together and effectively get this thing settled. We're not just going to keep letting you add to it and carry this on for years. Sorry, that's thrown out, can't do it. Now, penalties and the conclusion in the case. Not surprisingly, the court sustained accuracy-related penalties under 6662A for both substantial understatement and negligence in this case. Substantial understatement of the tax due, which means automatic 20% penalties. Now, both of these can be taken care of by a reasonable cause defense. But as the court noticed, the reasonable cause defense is particularly difficult to maintain given what the taxpayer did. All of us have to realize as a tax professional, even if you're not a CPA, EA, or attorney, if you're telling the world you're a tax professional and you're doing the tax work and you're advising people on it, the court pointedly noted that a paid preparer of over 3,000 returns in the period, he should have known better than to keep no records. You're not going to get a break on that. I think this has been tough for anyone to get a break on, but especially someone who claims to, tell people they have special expertise in handling tax matters. It's not going to work. And the takeaway for us and our clients is rather clear. Bank deposits are prima facie evidence of income, right? Overcoming that presumption requires contemporaneous, specific documentation, all of which was missing in this case. It'd been really nice, first thing, to have qualified that operation as a 501c3 charity, tax exempt. It would have been really nice to have had its own bank account. Been really nice to have some records where people actually, where the donations were made. They got receipts, they did other things, there's records issues, copies kept of them. All those things would have been really nice, and by nice, I mean required. Yes, testimony of charitable intent or after-fact reconstruction are rarely sufficient to rebut the concrete evidence of bank deposit. Even if that evidence had come in timely, more than 14 days before the trial date, had been brought to the attention of the IRS, it's still likely nothing would have changed. And of course, we have our nice little, infographic here. And again, talks about, in this case, the IRS assessment. There is the irony at the heart of this decision. We see the professional's paradox. You have a taxpayer who paid over 3,000 tax returns for clients during years at issue, yet he failed to maintain the most basic books for his Schedule C. That's never going to be considered a good thing if you're in the profession. We see the reconstruction. Basically, because there were no business books, the service utilized the bank deposit analysis. That's its standard tool for reconstructing income when a taxpayer has ignored the requirement to keep records under 6001, and the courts will buy it. It's going to be up to you to provide evidence of what those deposits represent that you claim are not income, and it's going to need to be more than you just swearing it's not income. Not going to work well. So when the IRS did this, they had $165,000 worth of items that just weren't on the return. And they successfully convinced the court, because that's the presumption, that those represent income. Now, his defense, right, when we start looking at the right side of the slide, you'll notice that we see the donation defense is just gone, right? It's not there. The taxpayer argued these deposits were charitable contributions he collected as a conduit for the refugee center. However, that defense failed because he kept no records of the cash and he commingled those funds in his personal account. It looked a lot like it was his own personal fund from which to take money. The legal standard here is dominion and control, right? Deposits into a personal account of which you have control are presumed to be income without very specific contemporaneous evidence tracing those funds to a third party, preferably with an absolute legal duty to transfer it to a third party. The conduit theory is going to fall apart. So the verdict, at the end of the day, the taxpayer was liable for all the taxes the IRS went after. They sustained deficiencies, and the court sustained the actually related penalties. Reasonable cause defense was dead on arrival. The court found a professional that does thousands of returns cannot credibly claim they didn't know the need to keep records. Remember, reasonable cause meant the taxpayers, took reasonable steps given their background to comply with the law, but due to causes beyond their control, they were unable to do so. You can't get that as prepared for not keeping records. That's simply not going to fly. Next up, we're going back to something I get asked about a lot when I'm lecturing in sessions, and that is what we had got last March, Executive Order 14247, the mandate to go to electronic payment methods. And we're going to talk this week about a couple of issues on this. First, the IRS updated and published a website called Understanding Your CP53E Notice, which is a new notice that you should be aware of the IRS will issue if a taxpayer has not provided bank account information with their Form 1040 and the taxpayer is due a refund. So, looking at again, we know we're in the middle of implementation of Executive Order 14247. That order, if you've forgotten, mandates a transition to electronic payments for federal disbursements and for receipts. This is the 53E is going to be on the disbursement side. On January 21st, the IRS released guidance involving a new procedural instrument. This is a Notice 53E, right? This notice is triggered specifically when a return is filed claiming a refund, but it lacked valid direct deposit information, either because it was limited entirely or the bank has rejected the initial deposit attempt. There are two ways to trigger it. The client didn't provide any deposit information, or the bank rejected. The key to understand is this notice is coming. You can't put on the return, I'm never giving you my bank account information. I never want a direct deposit. You absolutely can't do it. You can't make me. There's not a box for that on the return, right? The days of the service defaulting immediately to a paper check are over. If you're going to get a paper check, you're going to go through the ringer, right? This inserts a procedural step requiring a taxpayer to cure the deficiency electronically before the disbursement is finalized, or essentially wait 30 days and then 6 more weeks before they're going to get a check in the mail. So if your client wants to know when I'm getting my refund, it's, well, if you don't provide the bank information, it's going to be quite a while before you get it. And don't call me 2 weeks after we filed and want to know where it is, because, it's your problem. You created it. It's your problem. Sorry, I can't fix it. And that's important because this notice makes it very clear, and the website and the answers make it very clear that as a professional, we don't have any way of, quote, curing this or fixing this or speeding this up for a client. Most critical aspect is, what is the online-only restriction found in Notice CP53E? The guidance explained in the notice states the IRS employees absolutely cannot update bank account information over the phone. This also means, therefore, the Practitioner Priority Service, PPS, is effectively useless for resolving this issue. Because again, IRS employees can't update bank information. We need that information updated. They can't do it, right? You can't just call, right? Even with a valid power of attorney, we cannot update this information on behalf of the client through traditional channels. The taxpayer must personally log in to their IRS online account to enter the data. And remember, to get an IRS online account, they're going to have to be able to authenticate themselves. They have to be able to set up the account. And, clients have trouble doing that regularly. And so, they're going to say, well, can't you take care of this for me? No, you cannot take care of this for them, right? Actually claiming to be the client and, setting up an ID.me account, claiming to be the client, submitting stuff. It's like, yeah, that's not going to do. And you could handhold the client and bring them into your office and walk them through setting up the account. But as I'll tell my clients, that's going to be a paid for service. You'd have just given the bank account to start with, we wouldn't have this issue. So you really got to understand that, we can do that. I will probably be willing to help people in the interview. If I'm doing an interview with them, or they're coming in otherwise as part of the interview, sure, I can help assist you get an online account set up. But if you just refuse to do it, you do this and suddenly, I want my return faster. It's like, that's another, that's something we weren't engaged to do. So you need to come down and no, I can't just enter this stuff for you. And no, I can't call. No, I can't do any of that stuff. None of that can be done. So the burden is going on the taxpayer, the individual client. And it requires them to have active, valid credentials for the IRS portal or obtain them. All of this while they are, the clock keeps running and they don't have their refund. So probably not going to be the most popular thing in question, right? Now let's talk about how it works with timeliness and what happens if you don't respond. This notice triggers a strict 30-day compliance window. During that 30 days, the taxpayer they're looking for the taxpayer to access their account and provide the data. I mean, those are your options. Access the account, provide the data. No other option, right? If the taxpayer ignores the notice and refuses to create an online account or otherwise fails to act within 30 days, then we go to a paper check. However, we don't go immediately to a paper check. The guidance indicates a delay of approximately 6 weeks for the paper checks to be issued following the non-response or failure. So what's going to happen here is you're going to have 6 weeks plus 30 days. So over 10 weeks from the time the return is filed with the IRS, the time the CP53E notice is issued, until the time the clients will actually have the money in hand. So well over 10-week waiting period. And that's what's facing clients who just refuse to give the IRS the numbers. Okay? Now, if a client really doesn't want to do it and the client's okay with that long holding period, fine. But don't call me in a panic when you get the notice, because we know that's coming and they're not going to pay you. And that's simply how it works. Like it or not, we don't have an option there. Now, this does suggest, though, we want to be a little proactive in our pre-filing due diligence. The most effective strategy is to avoid the problem, right? If we can, on any client for a return where there is a refund or there could be a refund, and that's pretty much any one, because there always could be something comes up that changes or requires a change, or some we discovered they paid an estimate they forgot to tell us about, so the IRS shows an overpayment. You want to have the bank account information in there. Filing a return without this data carries a tangible penalty. It's going to generate a CP53E, and the client's going to have to intervene. And I strongly suspect that will be true if, they end up finding that the client had more withholding, and they told us about it, or more payments of estimates. Clients are known to get a little flaky about what estimates they paid and sometimes forget them, which seems really weird, but it happens, right? So we advise clients, particularly those accustomed to receiving paper checks, that missing banking data puts them in paper check jail for what's going to probably be over 10 weeks. So don't be looking for that to spend that refund check in 2 weeks to pay for a vacation. It's not happening, right? Also, probably helps to tell your clients, regardless of anything else, get an IRS online account. If there is a notice issued, then you aren't scrambling to authenticate, which is the tough part, your identity before 30-day clock is 30-day clock is clicking. And I think the other big thing about setting one up is you assure that nobody can somehow go in there and set one up in your name with fraudulent criteria. That could be bad because of all the information they could obtain, or their just ability to file a fraudulent return and get a fraudulent refund that appears to be filed by you. So be aware of that. We have our infographic here that explains what to do if they get a CP53E notice, what's going to happen. So this kind of summary, if the client gets the notice, right, your path forward is essentially you have 30 days to act and you must go online to do it. You have only one shot, right? This is the high risk. If you put in the wrong data or have other issues, you can't go back and fix it. If after you've entered this electronic data, right, so your client goes in, enters it, says, okay, I want my refund, enter it. They make a typo and enter the wrong account number. The bank rejects it. Well, they're not getting another chance for direct deposit, so they're going to be on that long-term delay. The best thing to do, because remember, if there's an error in entering the account number, we talk about the original return, which we certainly want to control for. Please make sure that you get the actual account number and evidence of the account number and the other information that's necessary. You get that from a bank document, preferably a voided check, rather than letting the client just write it down because they'll make a mistake. It's an issue. But even if there's a mistake made, then the CP53 will be issued, but now they have to go online to get it fixed, right? And again, finally, if you do nothing, then after the 30-day period is run, then there'll be 6 weeks later, you'll get the refund check. So that's how this works. Okay, next up, we're going to continue on with Executive Order 14247. The IRS on January 27th issued a brand new fact sheet entitled Modernizing Payments to and from America's Bank Account, fact sheet 2026-02. So this is an update, tells us how the process is going. The objective of this is rather clear. The executive order aims to reduce fraud and costs by making federal disbursements faster and more reliable. That, if you read the executive order, which is still on the White House's website, you'll find their theory about the fact that, paper checks are subject to fraud, they cost more to process, they're more likely to, end up with taxpayers getting money way later because they have to go through lost check procedures, etc. Now, for us, we need to be aware that this is not a future implementation. The transition began on September 30, 2025, meaning we're already operating under these new constraints for the current filing season. And while not everything, we're still in an in-process mode of transitioning here, there's going to come a time where the IRS draws a hard line. And a hard line's already been driven on, basically drawn on refunds, and will eventually be drawn on the question of, when in fact we get payments made, the same problem will occur. Now, the fact sheet notes what I just said. The IRS generally stopped issuing paper refund checks to individuals after September 30, 2025. Now, there are limited exceptions for hardships or legal requirements, like the default is now digital. That's going to be your key. However, if you're handling estate and trust matters, there is a key carve-out. The IRS clarified no changes have been made regarding refunds for deceased persons. If there's a refund for a deceased person, a check will be issued, right, under the current practices until further guidance. Now, all of this has that until further guidance is issued. So keep that in mind. Once that guidance is issued, the rules will change. And this is an FAQ. It could change tomorrow morning. So you always have to keep your eye on this thing. And I would suggest you do check on it every so often, looking for updates. There is a date on the bottom of the page that if you go read it right now, which I suggest you go do, it will tell you the date it was last updated. You just want to go back in, and if that has changed, figure out what changed on the page. That'll be your key. Right? So that's going to be how we look at handling it. Now, the fact sheet also reinforces the CP53E worksheet, workflow we discussed on the previous section. If a return lacks banking data, it's processed, a letter is sent, 30-day clock begins. Failure to respond and the results in a refund being released as a paper check only after a mandatory 6-week delay. So again, that's also mentioned there in the fact sheet. You can show that to the client and say, this is what's going to happen, and I have no way to help you. So you need to be aware of what's happening here if you don't give the information. Now, this one's more limited, but I know some people will set up their clients on this. Individuals can no longer have new EFTPS accounts created. That took place on October 17th, the end of the last filing season. If your client didn't have an EFTPS account set up before that date, on or before that date, you can't set one up. Individual clients not already enrolled have to use either the IRS online account or direct pay path to pay electronically, which will be the mandatory method at some point. We still don't know what some point is, right? While existing EFTPS users are grandfathered for the moment, this guidance in the fact sheet indicates a mandatory transition away from EFTPS for individuals later this year. So even those that are on EFTPS, some point are going to be transitioned off it. And this is my concern, is that this transition to payments could occur mid-cycle. I was thinking that the best option would be for the service to actually link it to a tax year. And for instance, have come in this year and said, okay, any taxes due with the 1040 this year must be paid electronically. Estimates must be paid electronically, period. We're done with paper. My concern is if they're going to do it later in 26, then we could be in mid-estimate cycle. So, you might pay the first and second estimate, and before time comes up to pay the third estimate, they switch. And now your client's got to go learn how to do the online pay or direct pay account. I strongly suggest that you strongly encourage your clients to figure out online payment methods. I don't care. You don't like doing things online. I don't care. Again, I don't wanna is not considered reasonable cost. I don't wanna is going to be a problem. Now, of course, you always can submit the bank account information with a return, and you could schedule estimates. The only thing I don't like about that is Treasury doesn't have a really good way to change an estimate that was scheduled with a return, aside from canceling every future one, which means now they've got to go back in and pay online anyway, which you may have been trying to avoid by sending that in with them. So I usually do the payment, via the return submission for the tax due on the return or for the extension. But for estimates where we're going to say we're going to be having payments that are scheduled out, from April 15th all the way through the next January, I'm not sure that's going to work out. I might need to change the amount, or we might end up with, let's say something happens, the client has, somebody gets control of their account. So the bank has to set up a brand new account. Now we need to have the old account shut down, right? The IRS not hit that one, hit the new account. There's not a good way of switching it. Now, for business clients, the rules regarding federal tax deposits are strict, and you can't use direct pay, right? Businesses are prohibited from using cash or card payments for federal tax deposits. These must be made by EFTPS or business tax account. And note for penalties for businesses, a failure to pay a federal tax deposit electronically can result in penalties unless you can show reasonable cause. That's really important for us to understand. And again, that's been around for a while, but they're basically reminding us. Now, the IRS also addressed some practitioner concerns regarding Circular 230. The guidance confirms that we may advise clients to use alternative electronic payment methods like EFW or online accounts while remaining fully compliant with our professional obligations. Some people were concerned about that. Yeah, it's going to be covered under part of tax practice and going to be under Circ 230. Now, for fiduciary and payroll providers handling volume numbers, the IRS has promised to expand digital options to facilitate bulk payments securely, acknowledging that the current infrastructure for that has been a pain point. And finally, for unbanked clients, the IRS clarified that using the vanilla direct at participating retailers would satisfy the payment requirement. Of course, they pay for that fee. But using retailers, if you go online and look into vanilla direct, there are ways to go into. You may remember a couple of years ago, they talked about setting that up at 7-Elevens, where you can go in and make your tax payment. So if you want to pay in cash, you can do that. You're going to be charged for doing it. Keep that in mind. This is not directly the IRS doing it. Now, the other thing is reliance on guidance, and especially for things like penalties. A crucial note wraps this up. The guidance is in the form of a fact sheet, not a regulation. It was not published in the Internal Revenue Bulletin. However, the service included a reliance provision. Any taxpayer that relies on these FAQs in good faith will not be subject to negligence or accuracy penalties if that reliance results in underpayment. Now, here's a big catch you got to do. Because their web-based FAQs could change without notice, you want to document the specific date and version of FAQ you're relying on in your client files to preserve the defense. I would suggest going to the website, printing, and highlighting, the date you printed out, and the guidance you're relying upon. So if a question comes up, guidance changes later, and somehow your client's underpaid, you have a way out of penalties. So keep that in mind. And again, we've got our infographics here. Graphic summarizes the why for the rationale behind the order. That's the very top section. While we're moving away from paper checks, the order says they are risky and inefficient. It'll reduce fraud and costs if we go away from them. As noticed in the fact sheet, the transition aims to make federal disbursements faster and more reliable than the paper system. Now, the scope of the change, which is found in the center of the page, is important to reassure your clients regarding this whole issue. Your tax filing process does not change. The IRS explicitly states while the settlement mechanism is changing, the filing mechanics remain as before. What's changing is how we file. Not how we file, but how we pay. And if you're willing to have us, at least for the 1040 amounts due, just put the bank account information with the return, we can take care of getting it paid. Now, refunds, look at the bottom left there. If you look at the screen, the new mandate places a premium on direct deposit path. As discussed with the CP53E, providing accurate banking data at the time of filing is the only way to ensure a frictionless refund and eventually be the only way to ensure a frictionless payment of any balance due on the return. For payments, the infographic highlights the electronic options. Remember, with the freeze on new EFTPS accounts, effective on October 25, you have to steer individual clients now toward direct pay or their own personal online account. Those are the ways you're going to get this done. Now, there is a warning because IRS is doing a lot of changes here. Clients should be advised that with this push for digital data, there is a risk that there's going to be phishing attacks, scam text messages, scam emails, claiming to be the IRS, claiming to be, oh, we got your return, we don't have the bank information blocked. Warn your clients. The IRS, in this case, will only contact you by mail. And even with the mail, be careful. Go to the places that I'm going to have discussed with you now, right, to get this set up and done. Get yourself taken care of there, right? Go ahead, set up your online account, find your information, be ready to go. I expect scammers will come, and while saying it'll only be by mail, I guess that's good news, right? Because email and text messages are much cheaper to send out, so scammers tend to use them. But if a scammer wants to invest in mailing, and some will, and risk mail fraud, don't just always assume. Be a little bit skeptical, especially if you submitted the bank information. We've done it before. We've used it in the past. That account's not been a problem. Be skeptical in those cases. But like I said, this risk is there for anybody that insists they're not going to, I'm not doing it and expecting to get a letter that's going to probably say not what we just talked about, that you'll get your check after 6 weeks, after 30 days are up, but rather you won't get your check at all. You'll never get the money. You're giving it up totally. Yeah, these scams are going to do that. Don't go for this text message. Don't go for the emails. Right? Only contact should be by mail. Should not be by phone for this issue. Phone calls also should be ignored. Just go down that path. And finally, most of us probably don't have this problem. Our clients tend to have bank accounts. But there are ways to deal with options like Vanilla Direct at participating retailers to satisfy the payment requirement, ensuring even unbanked taxpayers are not locked out of compliance. If your client really doesn't want to tell the IRS their bank account information in any way, shape, or form, then go there and pay that way with cash, the green stuff. It's not very convenient maybe, but it would keep all that out of their hands. Well, not really. We won't go through the fact they probably can get it very quickly regardless, but still, make the client feel better. Okay, you could use something like that. Okay, dropping out of that executive order now again. We're going to get ready. It's in process. It's going to change, and we have no idea when. Let's talk about now our final two developments here. I'm going to start out here with a case we discussed before, United States versus Neuberger, case number 1:22/CV-02977, the United States District Court in Maryland. And this particular opinion was issued on January the 23rd. Now, we've already talked about Mr. Neuberger, right? It's a taxpayer and attorney who is advising insolvent entities and who ended up being in a position where the court found that he had caused a disbursement from the insolvent entity that, basically made them insolvent so they couldn't pay their federal tax bill that he was aware of. We already discussed that, right? That part of the case is done. Now, that was the existence, there was liability. Did the representative have knowledge and was the entity insolvent? And both of those were already decided against Mr. Neuberger. However, in this part of the case, we're going to tackle the case of how much is that liability and how it's different and how it depends sort of thing. This is not technically a tax case. That's what the ruling is going to be. It involves a debt that was taxes owed, but they did pull it out of the tax issue there, right? So what we're going to find here is, does the representative's personal liability under Title 31, United States Code Section 3713B, which is the federal priority statute, not part of the Internal Revenue Code, automatically include all after occurring penalties and statutory interest under the Internal Revenue Code, Title 26? Or is it capped at the amount known at the time of the wrongful distribution? The government argued for the former. They treated the representative effectively as a taxpayer for collection purposes, but the court took a much more restrictive view in this case. To remind you how this went on, this involved a company, Leckham Holdings, which engaged in a tax shelter scheme involving improper interest deductions and transfers that the IRS would eventually say were not loans. Now, a defendant, Mr. Neuberger, managed a repayment plan to various creditors but he did it after receiving a 30-day letter from the IRS asserting, in essence, $1.88 million of deficiency penalties and interest. Despite this notice, Mr. Neuberger engineered a transfer over $8.8 million to other creditors, leaving the company insolvent. So, transferred money out, rendered this thing entirely insolvent, knowing that he already had a notice of deficiency, right? A 30-day letter, right? That they were going to be going after this of $1.9 million. He was aware of that out there, but he still paid over the $8.8 million to the other creditors, which meant IRS, tough luck, there's nothing left here. Sorry about that. No, the IRS sued, the government sued Mr. Neuberger personally under Title 31, Section 317713. And by the time of the trial, the government sought over $3.3 million, arguing that Mr. Neuberger was liable for not only the original $1.88 million, right, but also all the penalties and interest that continue to accrue against the taxpayer under Internal Revenue Code since the 2019 notice was issued. That's their argument in this case. Now, the government characterized their damage calculation as mere statutory arithmetic. If the taxpayer owes the interest under the code, then the representative owes it under the priority statute. But the judge in this case rejected that premise. The court distinguished the cause of action. This is a debt collection suit under Title 31, not a tax assessment under 26. So while Title 26 may require computation of such interest, Title 31 doesn't. He also distinguished the scenario from cases involving estate executors. Under Section 3713A1B of Title 31, an executor has a fiduciary duty regarding the estate's tax obligations. However, for other representatives, under Section 3713A1A, liability is triggered by specific events, transactional events, voluntary assignments, or acts of bankruptcy. Therefore, the automatic flow-through of Internal Revenue Code accruals that might apply to an executor, or the taxpayer does not automatically transfer to a non-executor representative that's caught up in this claim under the priority statute. And the time of payment rule is the key takeaway here for damage from litigation. The court adopted the reasoning that the operative variable for damages is the amount of the U.S. claim at the time of the representative's payments to the other creditors. Because the debt owed the government must be in existence at the time of the wrongful distribution, trigger priority, the liability is effectively capped at that snapshot in time. Consequently, the court limited Mr. Nurburger's liability to the $1.88 million identified in a 30-day letter, the amount known to him when he paid the other creditors. They denied the government's request for an additional $1.4 million in post-notice accruals of penalties and interest on the Internal Revenue Code. That is just out of luck on. Right? And then two procedural issues that are worth noting. That regarding prejudgment interest, unlike the statutory interest on the Internal Revenue Code, prejudgment interest in the Section 313713 case is discretionary. In this case, the court declined to award it here, distinguishes Mr. Nurburger from the cases involving self-dealing. Since he didn't pocket the money himself, the equities did not favor expanding the liability. Second, a warning on trial practice. The government attempted to submit interest calculation reports generated by commercial software in its post-trial exhibits. Again, we're talking about, basically trial by surprise. Okay? This was an ambush, and the court called the government out for this ambush, knowing that the defendant had no opportunity to cross-examine or look at the calculations. That is noted. Now, this is one that those of us CPAs, EAs don't worry about, but attorneys might want to take a look at this part of the case, remind them that if you're litigating damages, the math must be entered into evidence during the trial, not attached to a post-trial brief, which was one of the problems. So it's an extension of what we tried to do in our tax preparer case. Preparer tried to do later on a tax court case, but the same basic concept. And again, we have our infographic. This one has lots of pictures on it. Right, we have that. Well, the pathway to liability is the left side, right? This is liability under Title 31, Section 3713B. The triggering event was Mr. Nurburger, as representative, authorized transfers to other creditors, loans, and vendors while the company was insolvent. Crucially, as the March 2019 icon indicates, he did this after receiving a 30-day letter quantifying the tax debt at that time as approximately $1.88 million. That is the knowledge he was aware of and still transferred the money even with regard to that. And that establishes liability. He was stuck there. He's liable for that. But the government tried to escalate this, and that's on the bottom center of this, right? And this is essentially the rising arrow coming out of there that says, hey, the government is suing for a whole lot more. They don't just want the $1.8 million that was known at the time of the diversion, but they want now over $3.3 million. They attempt to attach all subsequent IRC penalties and interest, right, that continue to accrue against the corporate taxpayer to Mr. Nurburger personally, treating him effectively as the taxpayer for collection purposes. Now, on the right side of this diagram, we have the court's ruling, right? The infographic highlights the court's rejection of the statutory arithmetic. There is a frozen clock you will see on there. That represents the time of payment rule. It's frozen at that point. The damages under the federal priority statute are calculated based on the government's claim at the time of wrongful distribution. Subsequently, the damage was capped at the original $1,080,097.96 that was identified in a 30-day letter. They stripped away the $1.4 million in post-notice accruals because this is a debt collection action under Title 31, not a tax assessment. Now, the alternative, basically, kind of relief the government could have gotten would have been prejudgment interest. But that's a separate determination, not the mandatory Title 26 interest. It's discretionary. Because the court found no evidence of self-dealing, this was an attorney who did not take the money for himself, right? It went to other creditors. Now they were related parties to the company, etc. They were his client, but it wasn't for him personally. He personally didn't get the money. The court declined to exercise its equitable power to award additional interest. In this case, see, the key difference is the, quote, Title 26 interest and penalties was statutory. If he's liable for that, then, it's simply awarded. But rather, the court has said, nope, we have a $1.9 million transfer approximately that, he knew that liability was out there and he still stripped everything from the company. So that liability is there, but that's of that date. And then it's the discretion of the court whether there would be interest paid on that prior to the date judgment was entered. The court decided no. So it went from automatic accrual of interest and penalties to at the court's discretion if interest would be charged. Finally, historic and probably something you've never dealt with and never will, but it is kind of interesting, even though the actual structure is probably one that we never have worked with and never will work with. We're going to take a look here at the case of Aventis versus Commissioner. It's a public tax court case, first one of this year, 166 TC number 1. Came out on January 28th of this year. Okay. Now, this is significant, but it's a retrospective decision from the tax court regarding financial asset securitization investment trust, or FASIT. Now, FASITs were a structure that Congress repealed in 2004. In this case, though, the case is relevant not just for the $38 million officiate stake, but for its rigorous analysis of did you comply with the clear language of the statute and the limits of a substantial compliance doctrine to fix things that you just didn't quite do. And its opinion is a comprehensive dismantling of a legacy tax shelter structure, ultimately finding that the arrangements failed to qualify as a FASIT, which I wasn't going to refer to now, because calling it a financial asset securitization investment trust is a lot of words, from its inception. So any of you dealing with complex securitization or older structures relying on grandfather clauses, this opinion serves a reminder that strict adherence to the letter of the law is non-negotiable when specific statutory benefits are claimed. That's true not just for the thing here, where you might have those issues, but also any sort of special benefit you're trying to claim that's granted by the statute. You can't be fast and loose with the requirements. So, this transaction involved Aventis, a U.S. subsidiary of the French multinational Sanofi, which is seeking to securitize intercompany loan. The architecture of the deal involved three interests: a Class 1 note for the advisor, a Class 2 note for the bank, and critically, a Series AE stock issued to French affiliate SAAN for nearly $560 million. Now, the tax arbitrage that was in play relied on reclassifying items. Aventis treated the Series A/E stock as a regular interest or debt for U.S. tax purposes under the rules. They deducted the payments as interest. Meanwhile, the French affiliate treated these same payments as under French law, or under law basically, tax-exempt dividends. So the sub got a deduction and the parent was not paying tax. This mismatch allowed for deduction in the U.S. without corresponding inclusion income in France, provided you strictly followed the FASIT rules. And again, we've not been able to establish a new one since 2004. So here's the catch. Now, the court found the Series AE stock failed the statutory definition of a regular interest under Section 860LB1 on multiple fronts. First, under that section, a regular interest must unconditionally entitle the holder to a specified principal amount. Here, the stock's liquidation preference was tied to the fair market value of the FASIT's assets. Because the holder here bore the risk of asset fluctuation, there was no specified principal amount. That doesn't look like debt, looks like equity, right? Second, the interest rate requirement was not met. And by the way, while it clearly was equity, right, generally, if you met the FASIT rules for U.S. purposes, we're going to treat it as debt. But not having a specified principal amount in your equity structure, that killed that ability, right? And secondly, the interest rate requirement was not met. The statute demands a fixed or permits certain variable rates. These payments were discretionary dividends declared by the board. They were not a fixed entitlement, right? So that's a problem. Finally, regarding the repeal of FASITs, the taxpayer attempted to rely on a grandfather clause. And this is important. When you're trying to rely on a grandfather clause, like, we have, although it's not as difficult to stay within it, but, if you had a pre-2018 or earlier divorce decree, and there's alimony under it, you'll keep treating it as deductible alimony and taxable alimony unless there is a significant change in the agreement. And generally the parties then look to keep it in line, and they agree it was meant to change it. But most cases, if you blow the grandfathering requirements, you basically blow the grandfather clause, so you ungrandfather the debt, or you ungrandfather this loan, then it goes under the new rules. Remember, under the new rules, post-2004, this type of thing, even if it met all the old rules, would have been considered not to be debt, and those payments would not be deductible. In this case, the court said, you made a change you shouldn't have. You modified the terms by waiving a 90-day notice provision, which constituted an unauthorized modification after the grandfather date came. That terminated your grandfather status. So even if we didn't have a problem with the other things, and remember, the court ruled this thing never qualified under the old rules as a FASIT. But even had, as soon as you touched and you waived that 90-day notice provision, you would have lost the FASIT protection. And you would have lost the ability to treat those payments as interest and deductible for the U.S. subsidiary. So faced with all of these problems, the taxpayer argued, well, yeah, we did all that, but we substantially complied with the FASIT rules. Tax court was not impressed. Doctrine of substantial compliance applies procedural or discretionary or directory requirements, not to the substance or essence of a statute. Definition of regular interest, principal amounts, fixed rates are the essential statutory requirements to define what a FASIT is. The takeaway here is clear. You cannot use substantial compliance to cure a failure to meet the core definitional requirements of a code section. Strict adherence is required. So foot faults weren't there. They didn't comply. Didn't comply with not just little side issues, but crucial issues. You weren't going to get it. So let's go and talk about this debt versus equity analysis. With the FASIT structure itself invalidated, now the court had determined the tax treatment of underlying assets and payments. First, the assets. The court found Adventus remained the beneficial owner. It held the legal title, controlled the receivables, and bore the risk of loss. Therefore, the income from the assets was taxable to Adventus. Second, regarding the payment to the French affiliate. The court applied the Fin-Hay factors to determine if the Series AE stock was debt or equity. And these factors weighed heavily toward equity. The parties intended stock treatment for French tax purposes. That was the whole point. We had stock for French purposes and not stock for U.S. purposes. The instrument carried voting rights. Debts don't tend to do that. It was subordinated to other creditors, right? Creditors usually have preferential, and you only had preferential to other equity holders, but not to creditors. And it lacked a fixed maturity date, all of which we expect to see in a debt. Consequently, the payments were recharacterized as non-deductible dividends, resulting in a denial of the interest deductions, and therefore, you owe the tax, guys. So ultimately, we have this design, especially if you have one of these type of transactions that's still alive, how to make sure it is still alive and how not to kill it, right? So the scheme was on the left side. It was a flawed tax shelter because remember, this thing had problems from day one, right? It was a high stakes nature. We're trying to get tax arbitrage, right? And of course, that meant that we were going to be able to get a deduction and not pay tax. There was like a $12 million restated US dollars tax savings by being able to get, this deduction, and on the French side, not to pick up the income. That's what they're trying to do. Now, we have that background. Now, the structure is on the bottom left, right? It details instruments involved. The critical component was the Series AE stock held by the French affiliate SAAN. Note the magnitude. Nearly $560 million was poured into this instrument, which the taxpayer attempted to designate as regular interest debt in the FASIT to secure those interest deductions. The flaws, there were a bunch of those in the middle right. First failure, it lacked a specified principal amount. As the graph shows, in essence there with a little one next to it, it essentially, the redemption value was tied to the fluctuating fair market value of the assets because the holder bore the investment risk. It wasn't true debt. Second failure, it lacked a fixed rate. The payments were discretionary dividends declared by a board, not fixed or permitted variable interest required by the statute. In essence, if this was only sloppy errors, innocent errors sloppily made, you can't be this sloppy. That's what it's saying. So I did the substance analysis on the bottom right. Because statutory deductions failed, the court looked to the substance of the transactions using the Finhay factors as highlighted in the case. 11 of the 16 legal factors indicating equity investment, voting rights, subordination, and lack of a maturity date were key ones that did. So the verdict, the top right, the gavel established the financial impact. Characterization from debt to equity meant the payments were non-deductible dividends. The result, a deficiency of $38.5 million in total from years 2008 through 2011. Gang, it was a bad day in court. Okay. Well, this brings us to an end of our update for this week of February 2nd, 2026. As we move deeper into filing season, keep a close watch on the practical implications of the executive order. We know changes are coming, we just don't know when. The one strike rule in the CP53E notices and the freeze individuals EFTPS enrollments are likely to create some immediate issues, if you've had clients with EFTPS, and clients are going to start getting those notices. So you need to try to manage that proactively. You want to make darn sure you don't let a refund return go out of your office without bank account information unless the client is fully aware of, if there's a check coming. Obviously, you apply it to the next year, no problem. But if there's a check coming or a check might come, they need to understand that by not having that information in there for refunds, they're just out of luck, right? They're going to have a long wait for the refund. Okay. Now, that's going to be key. On litigation front, Hillenbrand gives a useful thing to consider if a client, and you do collection work, and a client claimed they never received a notice. Can you find facts that are good enough to overcome whatever evidence the IRS might have? Hillenbrand shows it's possible to have it. It's possible to make it work. And Neuberger provides critical limitation on personal liability for representatives handling insolvent structures. Could it be an insolvent estate? Maybe, although as noticed, it's questionable because there's another argument that they can make there because of the pure fiduciary duty to get it paid. But certainly if you're handling insolvent, corporation stuff, first thing is Neuberger tells you there's a risk involved in what he did, but also that the risk is not as high as the executor that ends up ignoring a known IRS debt. That's kind of the big issues. Now, if you have questions about these developments, as always, I do, pay attention to the Connect sites for the Arizona Society of CPAs, the New Jersey Society of CPAs, Idaho Society of CPAs, Minnesota Society of CPAs, Illinois Society of CPAs, and Washington Society of CPAs. So if you're a member of one of those organizations, you can post. And if I see your question, I think I might help, I may respond. Also, there is the email address that you'll find here on the last slide, eds@currentfulltaxdevelopments.com. You can email me there with quick questions. You'll also find the full text of articles on the website, right, currentfederaltaxdevelopments.com. If you go to our audio video, this week's broadcast, you're going to find these developments with the written materials provided with this session. And so, again, as always, I'm Ed Zollers. Have a successful week as tax season begins to start going. And we'll see you next week for more current federal tax developments.